I spent my summer here at home in Scotland, and how do you know when it's summer in Scotland? The rain gets warmer. And it was a bit like that this summer, but no, it wasn't too bad at all. An economy is going to be affected more and more by political reaction to climate change and by how popular opinion reacts. Last year's German economic slowdown was partly due to lower auto production because of new emissions tests brought in by Dieselgate. Jaguar Land Rover wrote off 3.6 billion at the end of last year, largely due to political climate-related decisions about diesel engines. We lent to them, and we had to downgrade the risk 2 notches. More capital needs to be applied. It becomes a more expensive loan in our portfolios. The Yellow Vest Gilets jaunes protests in France were triggered by political petrol tax increases related to climate concern and contributed to reduced activity in the service sector in the fourth quarter. And the seriousness with which we are all treating climate risks is suddenly evident, as though the financial community has crossed some sort of credibility line when it comes to looking at climate risk, literally in just the last 2 years. It's no longer just for environmentalists, that stopped a few years ago, and it's no longer a marginal financial product. For us in finance, the goal is clear. If there is a climate risk which can be identified, then it can be measured. Then we can meet the risk, building resilience on the one hand, and making better, perhaps more ethical credit decisions on the other. And for doing that, we should be seeking ways of achieving a lower Pillar 1 capital weighting for those loans, making green loans a better loan in every way. If we crack that, we've cracked climate risk challenge for banks. And I can tell you that we, along with several other banks that I know of, are actively looking at how to bring in differentiated risk ratings based on climate, as well as the usual credit factors. We're doing it right now. I expect it to come in next year in our bank. So any banker or investor who is not thinking now about how to introduce this aspect into their analysis of companies is likely to underperform. Similarly, I don't meet any corporate treasurers or finance officers who are not aware of the need to address climate concerns from shareholders, investors, and risk analysts. We know this. A decade ago, sustainable investment was about signaling awareness, sometimes at the cost of a slightly lower return. In the last 5 years, most investors have started to assume that they can do this without sacrificing return. The reality is that both green bonds and sector-neutral equity ESG strategies have been outperforming their benchmarks for at least 2 years. This is a trend that will only get stronger going forward because it's not now just about signaling awareness, but about mobilizing capital for better business investments that can speed up the transition. Most banks I see are overexposed to risk and underexposed to opportunity. Let's think for a moment about the EU's new taxonomy framework, which marks a major change towards a more realistic transition strategy. It says the capital that can be mobilized has to be used in the sectors that currently have high emissions, because only here can you get significant enough reductions. The basic elements in the strategy are the taxonomy, definitions, which identify a range of activities in the high emission sectors where we can contribute by abiding by things like specific maximum emission levels. There's a green bond framework, which allows for a wider range of issuers and a wider range of eligible products. Think light green for transition, dark green for pure zero carbon. Disclosure recommendations that explain how both portfolio managers and companies can share the information about their exposures that is crucial for all of this to materialize in practice. Benchmark portfolio guidelines that directly state that sustainable investors cannot underweight the high emission sectors, but have to work with them, inside them, to reduce greenhouse gas emissions. Very interesting. The common denominator here is that instead of excluding high emission sectors from sustainable portfolios, oil and gas, the framework urges us to create a race between companies in the very same sectors to complete the transition fastest, leading to better funding costs and better access to capital. Think Ørsted of Denmark, now one of the world's most prominent wind turbine producers, previously called Danish Oil and Natural Gas, with currently 0 oil and gas assets left. Going forwards, lenders and investors are likely to see it as a red flag if companies don't disclose exposures. They will shift allocations towards those that have the most credible transition plans. It's happening. The GEFI is an independent company, initially funded by the UK government and the City of London Corporation. Our mission is to focus on actively mobilizing capital towards an emission-free and climate-resilient economy. 2050 came in, zero carbon 2050 came in after the GEFI was set up. We're delighted to have that as a kind of guiding principle. We're financed by government, led by bankers, and we are positioned as the principal interface between the public and private sectors regarding green finance in the UK. The operating model is based on bringing together experts from industry, from finance, from academia, from civil society and government in coalitions, looking at specific tasks. These focus on identifying and then unlocking the barriers to capital flows towards defined challenges, retrofitting our building stock for one, avoiding further deforestation from imported commodities for another, and financing climate-resilient infrastructure for the third. These are the three initial areas of focus we're pursuing, seeking financial solutions and innovation to scale up the investments needed as quickly as we possibly can. Setting aside the complexities and the technicalities, we also see a very human dimension to the zero-carbon transition needed across financial services. Put simply, it's very hard to give up doing transactions in business you understand for those that you don't. And I believe, based on the models of disruption we've seen in other industries, introducing successful green financial products and instruments will pivot banks and capital markets towards a greener path. It can really work, embedding science firmly into global finance. Many of the actions that society, including the financial community, are taking today are almost unrecognizable from where we were just a few short years ago. It's really tremendous and it's urgently needed. So I encourage all of you, particularly the bankers, to get involved, get thinking, get moving, get onto your credit committees and make them start thinking about how to get that Pillar 1 capital allocated the right way so that we can make green finance the most obvious thing to do. Thank you very much.